The Federal Reserve, known as the Fed, is the central bank of the United States. The system was made possible by the Federal Reserve Act, which President Woodrow Wilson signed into law on December 23, 1913. This was done because of a string of bank failures and stock market panics that made people worry about the US's financial system, which is mostly unregulated. By creating a central bank, the government hoped to give the country a stable yet flexible authority that could handle its monetary policy, regulate its financial institutions, and strengthen the people's trust and confidence in the US economy. It may sound complicated, but this entity affects your financial choices and opportunities more than you may realize. Welcome to Money Talk, where we discuss tips on making money. And for this video, we are going to talk about the Federal Reserve and how it affects you and the US economy. But before we begin, don't forget to hit that like button, hit subscribe, and click that notification bell to receive updates and be the first to check out our latest videos. What does the Federal Reserve do? From the beginning, the Fed serves the public interest and provides a safe and stable financial system. Its responsibilities include maintain banking payment and transaction systems, make and monitor rules meant for banks and financial systems, ensure that consumer protection laws are being followed, manage the country's money and its supplies, and set key interest rates. The Federal Reserve affects us in many ways since the policies it makes affects qualifying for a mortgage, the interest on loans, and the interest on savings account. The Fed ensures people can deposit a check, use a debit card, and transfer funds securely and consistently. How is the Federal Reserve structured? It is composed of three major entities: the Federal Reserve Board of Governors, the 12 Federal Reserve Banks, and the Federal Open Market Committee. First is the Federal Reserve Board of Governors. The governors are the Fed's main governing body. The Board of Governors must be a fair representation of the financial, agricultural, industrial, and commercial interests and geographical divisions of the country. They meet twice a year before Congress. They also meet with the congressional staff to discuss financial issues and determine a course of action. The second is the 12 Federal Reserve Banks. If the Federal Reserve were a tree, these are the branches, 12 to be specific. Each one is responsible for a cluster of states called a district. It is responsible for enforcing the Board of Governors' decisions on a regional level. They oversee local banks, grant charters, and inspect operations. They also loan money to banks, take destroyed, defaced, or counterfeit currency, release new coins and paper bills, process and clear checks, and maintain U.S. Treasury bank accounts. Even though they don't set monetary policies, they provide economic research that helps the next and final entity to make decisions. And the third one is the Federal Open Market Committee. This is the most influential arm of the Federal Reserve and has 12 voting members that make policies. They meet 8 times a year. Their responsibilities are really important since they assess the country's economic conditions, manage the rate of federal funds, and conduct risk assessments on economic growth. In other words, they keep the economy moving forward. Now, let's talk about interest rates and how the Fed affects them. Since the Federal Reserve manages the money supply, they use interest rates, specifically and most importantly, the federal funds rate. What is the federal funds rate? It is the interest rate at which banks can borrow and lend to one another. Because of the Fed rules with quotas, banks must keep a certain amount of deposits in the reserve to ensure all account holders can take their money anytime. When you hear about the Fed lowering or raising interest rates, it's about the federal funds rate. It does not affect consumers directly, but it is the basis for other interest rates, like the prime rate. So, when the cost of financing for a bank goes down, the savings are passed on to people who want to buy a house, get a loan, or do anything else that involves money and finance. It also affects how much interest savings accounts and certificates of deposit earn in the long run. What impact does the Federal Reserve have on the economy? The Fed has ways to encourage banks to increase or reduce their financing activities. They can modify the reserve requirement. Banks have to keep a certain amount of their total deposits in reserves. If the Federal Reserve wanted to make more money available, it could lower the reserve requirement so banks could lend more money. If the government wants to circulate less money, it raises the requirement. They can set the discount rate. Financial institutions don't have to borrow money from each other. They can also borrow money directly from one of the regional Federal Reserve banks. They can increase interest rates paid on bank reserves. The Fed can modify the interest it pays banks on their reserves. Because banks will not lend money for less than that amount, the Fed's action sets a floor for market interest rates. It constantly gauges the pace of the economy. The Federal Reserve can help the country slow down or accelerate its investing and spending while keeping inflation low. Who is in charge of the Federal Reserve? Although the Board of Governors reports on its activities to Congress at least twice a year, it is neither supervised nor governed by anyone. It receives no appropriations or funding from Congress and is primarily financed by the interest on the U.S. Treasury securities it owns. But despite this, the Federal Reserve is accountable to the American people, operating in a very transparent manner, publishing its meeting minutes and public policy briefs on its website. What's the takeaway from all these? The central bank cannot significantly change the business cycle's upward and downward patterns. But the Federal Reserve can work to avert economic crisis by altering the federal funds rate, increasing the money supply, and cutting financing costs to banks, and ultimately to consumers. If you enjoyed this video, make sure to hit that thumbs up button, click subscribe, and hit the notification bell to receive updates on our latest videos. Also, feel free to leave us a comment. If you want to watch more videos, head on over to our channel to see more from Money Talk. See you!